Banking panics can be very disruptive for the financial system and the broader economy. To safeguard the financial system against panics, governments around the world have created two institutions: deposit insurance and the lender of last resort. These two institutions are often called the government safety net. In this session, we are going to discuss where banking panics come from and how the government steps in when panics occur. We will also examine how government interventions played out during the 2007 to 2009 financial crisis. Let's start with the question of why banks are fragile. We know that banks borrow short and lend long. We know that most bank assets are information sensitive, difficult to sell loans. These are illiquid assets. On the other hand, banks provide liquidity to depositors. Depositors can withdraw their funds on demand. If you want to empty out your checking account today, you can walk into your bank and you can ask for your cash. And the teller working behind the counter will have to meet your request. This liquidity mismatch between the assets and the liabilities is what makes banks fragile. At short notice, banks can have cash shortfalls that push them into insolvency. In a bank run, deposits and debt are quickly withdrawn. Usually this happens when liability holders worry that their bank has made bad investments. Banks only have so much cash and liquid securities on hand. Banks can try to liquidate their loan portfolio, but these illiquid assets might be sold at a loss, at fire sale prices. Even realizing those losses might take some time to happen. So anticipating this outcome, banks usually close their doors. This is why we see the old pictures of depositors lining up outside the bank. When a bank fails, this is bad news for savers and for borrowers. Savers may lose their deposits or access to the payment system. Borrowers lose access to financial services. The valuable information that loan officers have gathered may also vanish. To minimize these social costs, governments work with individual banks to reduce the chances of failure. However, this is not the government's main concern. The government is worried that the initial shock will spread through the financial system. The government is concerned about contagion. When depositors and creditors become worried about the health of the financial system as a whole, then withdrawals can happen across the board. This is called a panic. What are the sources of contagion? Why does this initial shock turn into a panic? The usual thinking is that there are two main sources of contagion. The first is about information asymmetry between depositors and bank managers. I am a depositor. There is a rumor that my bank has made some bad investments and might fail. True or not, I run to my bank and I withdraw my funds before the bank closes its doors. Along the way, I bump into you. Your checking account is with another bank, but now you begin to worry. What if there is even a small chance that your bank has also made bad investments? It is virtually costless for you to pull your funds out, so why wouldn't you do it? So long as depositors are uninformed, rumors can spread from bad banks to good banks. False rumors can even bring down healthy banks. The second source is more direct. In the 21st century, banks are highly interconnected. If a money center bank fails, then other banks might lose access to wholesale funding. Some banks sell large amounts of insurance or derivatives. If a bank selling these contracts fails, then the entity on the other side of the transaction might lose out. This is called counterparty risk. Regardless of how the initial shock spreads, financial panics can be very costly for society. Clusters of healthy banks can fail. If borrowers cannot access credit, then business investment, household spending, and overall economic activity may worsen. When the economy does poorly, more loans will default, making things even worse. This negative feedback loop between finance and economic activity can lead to deep and long-lasting recessions. We want unhealthy banks to fail, but we do not want banking panics. This is where the government steps in and creates a safety net. This safety net involves two institutions: deposit insurance and the lender of last resort. Together, these institutions form a two-pronged attack against banking panics. Let's explain who these institutions are and how they work. Let's start with deposit insurance. In most countries, there is a deposit insurance program. In the US, we have had the Federal Deposit Insurance Corporation, or FDIC, since 1933. Banks pay for deposit insurance. If a bank fails, then the retail depositors at that bank, that's us, we do not lose any money. The bank might be gone, but the customers get their money back. There is an insurance limit. As of 2020, that limit was $250,000. That is more than enough coverage for regular customers like you and me. The FDIC will resolve the failed bank. There is no bankruptcy court for banks. Instead, the FDIC takes care of it. Usually this means that the failed bank will be auctioned off to another healthy bank in the community. Your checking account will sometimes just be transferred to this healthy bank. Nowadays, this is a quick and easy process. So here is our failed bank. The depositors get paid off in full by the FDIC. They bear no losses. And the FDIC takes the assets and auctions them off later. Deposit insurance prevents bank runs. I am a depositor. I hear a rumor about my bank making some bad investment. Why should I care about the rumor? In the worst case scenario, I'm going to get my money back from the FDIC. This might be mildly inconvenient, but that's probably better than leaving the office, running to the bank, pulling my funds, and putting them somewhere else. We have all heard of central banks. In the US, we have the Federal Reserve System. This has been around for over 100 years. One of the key functions of the Fed is to act as the lender of last resort. You might not have heard of that before. This involves the Fed giving cash loans to solvent banks. These are healthy banks experiencing runs. For whatever reason, liability holders are withdrawing funds. Rather than selling loans in the open market, which we know is a bad idea, the bank can turn to the Fed. Provided these loans are high quality, the Fed will take them as collateral in exchange for a short-term cash loan. The bank takes this cash and can stand ready to meet the demands of its depositors. Once depositors realize that they will get their money back, they have no incentive to run. At that point, the bank can pay the Fed back on its loan. The lender of last resort provides cash loans to healthy banks. This stops bank runs that are in progress. The FDIC reduces incentives to run in the first place. It is a before-the-fact device. The Fed stops runs once they emerge. It is an after-the-fact device.